Here's a frightening number that should concern every American retiree. The IRS collected over $1.8 billion in RMD penalties last year alone. That's right, billion with a B. And the worst part? Nearly 90% of those penalties were completely avoidable. The average senior who misses their required minimum distribution deadline pays a penalty of $4,700. That's money going straight to the government instead of staying in your pocket where it belongs. I've seen retirees lose their entire vacation fund, their emergency savings, even money set aside for grandchildren's education, all because they didn't understand 5 simple rules. Today, I'm going to walk you through exactly what triggers that brutal 25% IRS penalty, and more importantly, how to avoid it completely. Stay with me because this could save you thousands of dollars. Let me explain why this penalty exists and why the IRS takes it so seriously. When you contributed to your traditional IRA or 401k over the years, you got a nice tax break. The government let you deduct those contributions from your taxable income. But here's the deal they made with you. Eventually, you have to pay taxes on that money. Required minimum distributions force you to withdraw a certain amount each year, starting at age 73. If you don't take out enough money, the IRS hits you with a 25% penalty on the amount you should have withdrawn. Let me put that in real dollars. If your RMD was $20,000 and you forgot to take it, you owe the IRS $5,000 in penalties alone. That's on top of the regular income tax you'll still owe on the withdrawal. This penalty used to be 50% until recently, so consider yourself lucky it's only 25% now. Now here's where it gets really complicated and where most seniors make costly mistakes. The RMD age has changed multiple times in recent years, causing massive confusion. Before 2020, you had to start taking RMDs at age 70 and a half. Then the Secure Act pushed it to 72. And now, thanks to Secure Act 2.0 passed in late 2022, the age is 73 for people born between 1951 and 1959. If you were born in 1960 or later, your RMD age is actually 75. But wait, there's a trap. If you turned 72 in 2022, you still had to take your first RMD by April 1st, 2023, under the old rules. I've seen people assume the new rules applied to them when they didn't. One gentleman named Robert thought he had until 73. He was wrong. His penalty was $6,200. The rules that apply to you depend entirely on your birth year, and getting this wrong is the #1 mistake I see. Let's get into the first critical solution. You need to know exactly when your first RMD is due. Here's the step-by-step process. First, find your birth certificate or Social Security statement to confirm your exact birth year. If you were born in 1951, you should have already started RMDs. Born in 1952 through 1959, your first RMD is due the year you turn 73. Born in 1960 or later, you have until the year you turn 75. Now here's an important exception for your first RMD only. You can delay your very first distribution until April 1st of the following year. So if you turn 73 in 2024, you could wait until April 1st, 2025. But be extremely careful with this option. If you delay, you'll have to take 2 RMDs in 1 year, which could push you into a higher tax bracket. I recommend most people take their first RMD in the year they turn 73 to avoid this tax bomb. Solution number 2 is calculating your RMD correctly, and this is where many people make errors that trigger penalties. Here's exactly how to do it. First, find your total IRA balance as of December 31st of the previous year. You can get this from your year-end statement or call your financial institution directly. Next, you'll need the IRS Uniform Lifetime Table, which I'll explain. Find your age as of December 31st of the current year. Look up your life expectancy factor on the table. For example, if you're 73, your factor is 26.5. If you're 75, it's 24.6. At 80, it's 20.2. Now divide your account balance by that factor. If you had $500,000 in your IRA and you're 73, divide 500,000 by 26.5. Your RMD would be $18,868. You must withdraw at least this amount. You can always take more, but never less. Here's solution number 3, and this trips up almost everyone with multiple retirement accounts. If you have more than one traditional IRA, you must calculate the RMD separately for each account. However, you can take the total amount from any one or combination of your IRAs. Let me give you an example. Say you have 3 IRAs worth $100,000, $200,000, and $150,000. You calculate each RMD separately based on each balance. But you can withdraw the entire combined RMD from just one account if that's easier. Now here's the critical warning. This flexibility does not apply to 401k accounts. Each 401k requires its own separate withdrawal. You cannot combine them. If you have an old 401k at a former employer and a current 401k, you must take an RMD from each one separately. Many retirees forget about old 401ks sitting at former employers. Call the plan administrator at 1-800 numbers found on your statements to confirm your obligations. Solution number 4 can actually reduce your taxes while satisfying your RMD. It's called a qualified charitable distribution, or QCD, and it's one of the smartest moves available to seniors 70 and a half or older. Here's how it works. Instead of taking your RMD and paying taxes on it, you can transfer up to $105,000 directly from your IRA to a qualified charity. This counts toward your RMD, but doesn't count as taxable income. Let me show you the math. If your RMD is $20,000 and you're in the 22% tax bracket, you'd normally owe $4,400 in taxes. With a QCD, you donate that $20,000 directly to your church, favorite charity, or nonprofit. You pay 0 taxes on that distribution, and the charity gets the full amount. You must be 70 and a half, not 73, to use this strategy. Contact your IRA custodian and request a direct transfer to the charity. Never take the money yourself first. Solution 5 addresses what to do if you've already missed an RMD deadline. Don't panic, but do act immediately. The IRS actually offers a way to potentially eliminate your penalty entirely. Here's your action plan. First, take the missed RMD as soon as possible. Withdraw the full amount you should have taken. Second, download IRS Form 5329 from irs.gov. Third, complete Part 9 of the form, which deals with RMD failures. Fourth, write a letter explaining why you missed the deadline. Valid reasons include serious illness, death of a family member, or incorrect advice from a financial advisor. Fifth, request a waiver of the penalty by writing RC for reasonable cause on line 54 of Form 5329 and enter 0 for the penalty amount. Mail the form with your explanation letter to the IRS. In my experience, the IRS grants these waivers about 80% of the time for first-time mistakes with good explanations. Solution 6 is about automating your RMDs so you never miss another deadline. Call your IRA custodian or 401k administrator and request automatic RMD distributions. Most major institutions like Fidelity, Vanguard, Schwab, and T. Rowe Price offer this free service. You can choose monthly, quarterly, or annual automatic withdrawals. I recommend monthly distributions because they act like a paycheck and make budgeting easier. You can also choose automatic tax withholding. The IRS requires 10% federal withholding on IRA distributions by default, but you can request more. If you're in the 22 or 24% bracket, Consider withholding 22% to avoid a surprise tax bill in April. To set this up, call Fidelity at 1-800-343-3548, Vanguard at 1-800-662-7447, or Schwab at 1-800-435-4000. Tell them you want to set up automatic RMD payments. This takes about 15 minutes and gives you complete peace of mind. Now let me warn you about mistake number one that I see constantly. People assume their Roth IRA requires RMDs. This is completely wrong. If you have a Roth IRA in your own name, you never have to take required minimum distributions during your lifetime. The money can grow tax-free forever. However, here's the trap. Roth 401k accounts inside an employer plan did require RMDs until 2024. Starting this year, thanks to Secure Act 2.0, Roth 401ks no longer require RMDs either. But if you inherited a Roth IRA from someone else, different rules apply. Beneficiaries of inherited Roth IRAs must take distributions within 10 years of the original owner's death in most cases. I've seen people confuse their own Roth IRA with an inherited one. One woman thought she had no RMD requirement, but her account was actually inherited from her mother. Her penalty was $3,800. Check your account statements carefully to confirm ownership. Mistake number two involves the still working exception, and getting this wrong is extremely expensive. If you're still employed and participating in your current employer's 401k, you may be able to delay RMDs from that specific 401k until you actually retire. This only applies if you don't own more than 5% of the company. But here's where people mess up. This exception only applies to your current employer's plan. It does not apply to IRAs, old 401ks from previous employers, or any other retirement accounts. One gentleman was still working at age 75 and thought all his accounts were exempt. He had 2 old 401ks and 3 IRAs that absolutely required RMDs. His combined penalty was over $11,000. If you're working past 73, take your RMDs from all accounts except your current employer's 401k. And even then, confirm with your HR department that your plan allows this delay. Not all plans offer this exception. Let's wrap up everything you've learned today. The 25% IRS penalty on missed RMDs is brutal, but completely avoidable. Remember these key points. Your RMD age is 73 if born between 1951 and 1959, and 75 if born in 1960 or later. Calculate your RMD using the December 31st balance divided by your life expectancy factor from the IRS table. Multiple IRAs can be combined, but 401ks cannot. Use qualified charitable distributions to satisfy your RMD tax-free. If you missed a deadline, file Form 5329 immediately and request a penalty waiver. Set up automatic distributions by calling your custodian today. The phone numbers are Fidelity 1-800-343-3548, Vanguard 1-800-662-7447, Schwab 1-800-435-4000. Now hit that subscribe button and click the notification bell, because next video covers the 5 Social Security mistakes that cost seniors $20,000 or more. You won't want to miss it. Thank you for watching, and take care of yourself.